Get my dollar trade playbook to learn how to position, profit, and protect during a dollar devaluation. Scan this QR code or click on the link in the description.
What that basically means is selling puts has been kind of guaranteed. It's like guaranteed money. We have had such incredible strength in this market over the last 6 or 7 or 8 weeks or whatever it's been. One of the most incredible rallies with barely a downtick. We know how we've shrugged off almost everything. And so it's very unnatural. I mean, I think on the one hand, so you can see this here, you've been just selling puts and basically you've been putting money in your pocket. And so a good sharp is what, Samantha, like 2? This is 10. This is off the charts. This is like, you cannot go wrong selling one-day puts. It's a lock.
Until you can't.
Yeah. And so that on the one hand, that's not natural. On the other hand, I think it does speak to, you look at vol numbers across the board, everything's just down. And so Mandy was talking about this from CVO. She's saying, listen, everything's down, down, down. If I saw the VIX down, but the move index was up, some other things are up, everything is just down. So some people might interpret that as complacency. There's complacency. It's a very, very strong rally based on all these things that we're talking about, incredible unknown productivity growth. This is sort of, as I said last week, it's a known unknown. We know it's happening, but we don't know how to quantify it. We're not going to know until we start to see it start to work its way into industries and companies. And then we can kind of go, oh, okay, well, this company seemed to get this benefit from that. Even then, that's like a lot of internal policies. How do you know that company B is doing the same as company A? So it's just going to be a whole new world of, well, how does this really affect us? And then to your labor point earlier, well, it is going to affect labor. There's zero question of that happening. Zero. So that's going to be a problem at some point. And I've been you can see that I'm pushing into some of the rate sensitive areas, even some IDU, things like that are a bit more utility, a bit more power. So you get a little bit of both. You get a little bit of exposure to AI, but you also get a little bit of exposure to rate sensitivity, even though yields are quite low, as you would expect in that area. So in terms of hedging, someone's asking, how far out are you hedging? Well, the nice thing is, and it can be like flipping a switch, when you get that July to August, everyone kind of goes, well, what the heck just happened here? We just had 2 months of you can't lose, and we just showed you the sharp. I mean, it's literally been no lose selling puts in this market. It's been a guaranteed trade. And so you have to just be aware. I often tell traders, listen, once you start to see things turn the other way, don't start betting against that. Don't figure the market's wrong. Once it starts giving you evidence that things have turned the other way, just be careful, especially going into that August, September period. You may be bullish on AI as I am, but there may be some softness coming, especially after this very, very incredible run. So I have been hedging. I'm probably going to keep doing that in a number of areas, but I'm looking at some option pricing right now in the SPY, very, very low, 30 days quite low. So the options have been silly low. And that's what I mentioned. I think last week I said, listen, there comes a point where the VIX doesn't really want to drop anymore, even though what we call realized volatility, which is just, okay, how much have we been moving, which is we know has been very little. At some point, it starts to has this big gaping space between it because realized almost goes to nothing. And you're like, wow, the market may never move again. And the VIX just kind of goes, well, I don't believe that because I've been around for a long time. So you get this really big gap, which is technically what we call volatility risk premium. That is like, boy, if the insurance is priced at 1,500 and risk is at 500, well, you should do that all day long. Well, that's what I teach in one of my courses. I say, listen, no, that's where you have to be careful. When that gap gets too big, that is a sign that things are maybe too quiet, too complacent, too whatever, because markets aren't meant to just literally go up every day. So we are at that point where I think you have to entertain the possibility that we could have a 200-300 point pullback. So look at this. So you're looking at about, let's say this is measuring a 30 delta put on the S&P on SPY on 6-month puts. So we've come down from the April levels. Let's ignore this historical volatility. It's a little nuts. So we've come right down and we've actually pushed a little bit lower as we've moved into Samantha's 1458 or whatever it was. We kind of pushed down, 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 down. We've broken those lows from April, from this period of April, and we're back into the lows just about of that previous period. And if you recall last year, we had a skew was cheap at one point before that August sell-off, but we're back to that point where things are a little bit cheap. So this is where you can step in. And I have not been getting bearish, but I'm saying this is what you've been waiting for as a hedger is when things get super, super cheap. So I think you can put yourself, we talked about a put spread last week. I think if you wanted full convexity, which means just like, don't worry about a spread, just grab some out of the money puts. I actually had a class last week and we sort of talked about buying almost like black swan type protection and how if you were to buy a spread, you limit your protection to the downside. So you buy a put, you sell a lower put, and you get that protection in between, less the premium you paid. side. What if, and we kind of played with this, we sort of said, well, what if we just bought something further out, like a 400 put or a 420 put on the SPY, and just really loaded up and bought like 4 times as many of those, because you can afford so many more. Let's say you have a risk budget of $10,000. Well, you can afford way more puts when they're further out of the money. What you do when you shock that, so anybody who's sort of using Thinkorswim or one of these decent platforms, is you can vol shock that, which means you don't just look at what your puts are going to make if the market drops 150 points. You need to bring into the picture the fact that option pricing is going to explode. What you can do in there, this is a lot longer topic than we have time for, but you can increase the volatility and say, oh, well, that's going to make me another 40% more, 30% more. And so it was a very interesting result that showed it was quite beneficial. But of course, the further out you buy those puts, the less reactive they're going to be to a smaller sell-off. So when you do that, you're kind of betting on, okay, I can handle a 7 or 8% sell-off in the market, and I'm not going to lose sleep over it, but it's the 15, 20% end of the world that I want to protect against. In the meantime, you have to accept some of it. Yeah, it's not that they won't go up. You're going to be able to monetize them a little bit. But if you want something more reactive, so I know advisors who buy 5% out of the money puts because they know at some point you're going to sell off, they're going to make a little money, and they can call their client up and go, hey, look, I made you some money on a few puts and they look amazing. So you can play that game as well. They're just more expensive. So I kind of like going 6 to 12 months and somewhere between those realities. So not 5% out, but I like to position around 13, 14% out minimum in terms of how far out of the money my puts are. And that's a nice place where you get that Vega exposure, which is going to give you a nice punch if the VIX goes up, which, by the way, Samantha, the last point I'll make here is there was something from Nomura. Remember last year how we were talking about VIX all the time and how reactive it was to the sell-off? It was extremely reactive. We had all-time, like not all-time high beta of the VIX to the SPY, but we're super, super low again. The VIX does not care. Maybe that's another sign that we can add to our book of, wow, things are almost too quiet. Things are complacent. The VIX just doesn't care. And the irony of that is as you move out of the money on those VIX calls, there's a lot of VIX ETN buying that has to happen. So the VIX is quiet. You get the VIX to 2022 again, and it's setting up for something potentially special that's going to maybe, I'm not saying it's going to be a massive vol squeeze, but it is starting to look a little bit like that, where there are risks to the upside from those short gamma positions that market makers have on. So it's kind of, as we talk about sometimes, it's quiet until it's not quiet and it gets crazy.
All right.
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here and subscribe to LaDucTrading YouTube channel for more content.